Well, good morning, everybody. Welcome to the February 2025 edition of the Ag Economic Dialogue Sessions. We find you on a slightly warmer day today than the past couple that we've been enjoying up here in the great state of South Dakota. So, positive above zero numbers in the double digits. That's kind of a great thing to kick off the whole meeting and stuff with today. So, without further ado or anything extra, because I'm sure we've got some dynamic presentations coming up, I'm going to turn everything over to Dr. Diersen and Dr. Sellars, cover the cattle market fundamentals and some fertilizer price outlooks, and we will go from there. As always, feel free to ask questions, type your questions into the chat, or save them for the end, and we can chat with the presenters after that. So, with that, Matt, if you want to take it away, we'll go from there.
All right, sounds good. Thank you, Heather. We'll take a look at some of the cattle market fundamentals. Got some prices, got some inventory numbers, some maps and such to show you. Just kind of do a quick overview of what's happening in the cattle market right now, predominantly from a supply standpoint. A lot of the information I will have comes from the Livestock Marketing Information Center. Your tax dollars support the LMIC. They're located outside of Denver, Colorado, but they put together a bunch of prices and charts and such that we utilize. If you'd like some access to that you don't have, reach out to me or anybody else listed on the back of the red book shown there, the herd book shown there on the screen. But I'll have some information from the LMIC and just to share that again. Total cattle numbers, big picture, cattle inventories were down again in 2025 compared to the last few years. So that means fewer cattle are out there. And just spatially here, you can see that cattle are located across the United States. A couple of states jump out here, Texas and California, for example. They would have both beef cows and milk cows. So that just need to be aware of that. This is all cattle across classes and everything else. Specific to beef cattle, you can see that if you isolate the numbers out or take a look at just where the beef cows are located, so where our calves born or where our cow-calf operations located, the Plains states kind of dominate the picture. So Texas is the number one, Oklahoma is number two in terms of beef cows with calves, and then always seems a little odd to me, Missouri is number three in terms of beef cows out there. So gives you some idea spatially of where the cattle are located. This last map here is the feeder cattle supply outside of feedlots. So if we look at the number of calves and add in the number of other heifers or heifers not deemed as replacements, add in the number of steers, and then subtract off the number of cattle on feed, you're left with this residual or leftover number of feeder cattle outside of feedlots. So those would be feeder cattle that could end up going into a feedlot at some point in the future. And you can see here, you got a lot of states in gray now. So those states no longer have any kind of breakout in terms of cattle on feed. So you've got less information out there because fewer operations have a significant number of cattle. However, the states showing up yet on the map do have a large portion, especially a large portion of the feeder cattle outside of feedlots. So they still tend to be large cow-calf states, large feedlot states. So subtracting out all those numbers, you can see the distribution there showing Texas, for example, with a large number, absolute number of feeder cattle outside of feedlots at this time. Most of the cattle numbers, regardless of class or type, were lower at the national level. And we got a little bit of a different situation at the state level. But that lower national supply picture, again, this is based on projections from the LMIC, should lead to better cow-calf returns. So this chart has data there from 23, 24, 25, and 26 on the right-hand side. So you can see 24 was a good year for calf prices. but they're projecting, or the LMIC is projecting, even better prices and returns in 25 and 26. You can see also that those returns probably in 24 exceeded already the last high return year, that 2014 year, shown on the chart here. So from a nominal perspective, the price was obviously better, or the returns were obviously better in 24. And then we've done some calculation to back out inflation. So I think in 24, we finally exceeded the level, or the price or return level from 14 after adjusting for inflation. So the real return was finally there, maybe giving a chance to, or facilitate or allow for some returns driven expansion of cattle numbers going forward. The national picture is corroborated, I think, if you think about it that way, with the USDA baseline. So this baseline was initially put out in November. They didn't do any revisions on this during this last week. Next week is the USDA Outlook Conference in the Washington, D.C. area. So on the chart here for inventories, the bars show that let's see if we can get a highlighter in here. 25 would put us right there for inventories shown on the left-hand margin. So inventory is expected to be steady or declining, depends on your view, in 26. And at the same time, the price is shown on the top there on the row or the line chart, and that's the return to calves at the national level. So that would be USDA calf price, typically a calf weighing less than 500 pounds, with a farm level price put together by the USDA. That price tends to be highly correlated with the price of 5 to 6 weight steer calves in South Dakota sale locations. So you end up with a pretty good indicator that the high prices would be largely supply driven in 26 and 27, and 26 in this case would be the high mark in terms of price received. So, but 27 looks okay too. What that means at the end of the day is you're looking at a few years projected of good prices, good returns to the cow-calf side of things. Check my notes here too. So switching now from the national perspective, nationally, fewer cows, fewer calves, fewer feeder cattle outside of feedlots, taking it down to the South Dakota level, got a little bit of a difference. On the female side, we do have a smaller number of beef cows again in South Dakota compared to last year. That's the top row going across there. That's not offset in total by a slight increase in the number of milk cows in the state. That has been a longer trend here in the last 5 to 10 years, adding some more milk cows, but it's not enough to offset the decrease in beef cows in terms of aggregate calf crop and whatnot. So beef cow numbers continue to decline slightly. The other two heifer categories, the beef replacement heifers and other heifers, so heifers not yet deemed replacement but weighing more than 500 pounds, both of those numbers were up. So that's in pretty good contrast to the national level. But the beef replacements, for example, is not up enough to offset what had been a decrease in the beef cow numbers. So we don't see immediate expansion likely in South Dakota, but the setting the stage a little bit more compared to the national level. As far as the other classes, again, that calf crop itself was a little bit lower because the number of beef cows was down, fewer cows, fewer calves, even though at the national level it looked like the calving percentage was a little bit better than it had been. The other two numbers on there, the on-feed number was up slightly, and with the slightly lower calf crop, it still matters as far as what gets retained. So there was a larger number of calves held back or retained through the end of the year. So as of January 1, there were more calves on hand, there were more steers on hand, there were more other heifers on hand. Even with a few more cattle on feed, it resulted in South Dakota being one of a couple of states with a significant increase or a large increase in feeder cattle supplies outside of feedlots. So many of the states don't report. Many of the states had very small changes. Texas led the nation with an increase in feeder cattle supplies outside of feedlots, even though they didn't have a very large increase in replacement heifers. And South Dakota is number two there with 115,000 more feeder cattle outside of feedlots. So pretty good contrast or shows the impact of um, tighter cattle supplies throughout the plains, especially our neighbors directly to the three neighboring states to the south, and then a little bit of an uptick as you get back into Texas. So if you're looking for calves to refill a feedlot, there's only a couple of states with bigger numbers to look for or to look to compared to a year ago. So that's the biggest stark contrast I see nationally versus uh, at the in South Dakota or at a more localized level. As far as prices, prices for calves, the end of, well, throughout 2024, they were okay. There was some seasonal pressure, September, October there. And since then, prices got back up close to $350 a hundredweight for a 5 to 6 weight steer calf sold at an AMS reported sale barn in South Dakota. And since the first week of the year, which included much of mainly December 24 prices, since the beginning of the year, the price has been above 350, 360, 370, depending on the weight. And it stayed up at a pretty high level for the first part of the year. Will there be supply pressure? Well, a smaller calf crop nationally would be rather supportive of prices. You're also dealing with a lower corn price, which has been very supportive of calf prices. So as corn has crept up a little bit, that's put some pressure on calf prices here in the short run. And as fed cattle have fallen a little bit as far as futures prices, that's put a little downward pressure on calf prices here in the short run. We take these weekly prices and do aggregate them up along with some other prices and put together a monthly price series. So I've got just a QR code here on the extension SD State EDU website. There is a monthly cattle prices and basis levels document. It's a few pages of a chart and then some various price and basis tables. All monthly prices that we highlight at different times. Give you an example of some of those. They told me yesterday that QR code's active, so if you click on that now or later, it would take you to this directly to this page. But here's some of the types of prices we have. So those same weekly calf prices, the stocker prices, I aggregate that up monthly and it gives us that top row of prices going across there. So you saw that pretty sharp seasonal dip in September last year. And then we've got feeder prices, South Dakota sale barn feeder prices, 7 to 9 weights. Fed steers run through the Sioux Falls Regional Livestock location, and then cull cows had been coming from AMS reported sales in Sioux Falls Regional Livestock until the month of December when they no longer had an AMS reporter there. So that price in December is a simple average of the prices that Sioux Falls Regional posts to their website. So it took a little bit of work to pull that price out, and that leads us to wonder, or I've been wondering out loud, do cull cow prices matter? How much effort would it make sense for us to put into seeing if the price of cull cows for different quality levels, weights, and whatnot matter? So, Heather, if you would you throw up we do have a poll question for folks. If you're familiar with marketing of cull cows, so this would be cows that usually you think of it as a cull animal not to be returned to, not sold as a bred replacement or something else. Literally a cull animal what matters when you think about marketing cull cows. Maybe you don't have cows, that's fine. Maybe you use one sale location. If you do compare multiple locations, that would be interesting. Um, what's missing without the AMS reporting is we don't know the quality grades of cull animals run through the sale barn. So might be quoted as you might have sale barn specific information on a sale report, but it lacks some of the detail. So give us a little bit more time here. Because what we've tried to do then is see if it matters, if it makes sense to try to pull different price information from different locations or across different weights. So kind of an open-ended uh, question or inquiry there. If you've got some additional insights on that, reach out to myself or perhaps Heather and share your thoughts with us. I'm going to end the poll. There we go. So a couple people just take it to the local sale barn. A lot of people just want to hear what Sarah's got to say about fertilizer. Understood. So I'm going to close this up and keep moving. Um, with fed steers, one thing we do with those prices for the fed steers, put together a seasonal price index. So this is 10 years of prices averaged together to build this seasonality chart. You can see you've got relatively high prices during the year in March, April, and May, and then a little bit of a seasonal low in September, October. So that price seasonality that you see in the cash price also shows up in the basis level. So here's the 5-year average basis for Sioux Falls Regional. So this would be the cash price, fed cattle, Sioux Falls Regional compared to the nearby futures price. So January cash price versus February futures, for example. With that seasonality in the cash price, you end up with seasonality in basis. So you've got a pretty high basis level expected during the month of May, a little bit also in June. So, but more or less that's reflecting seasonality in cash rather than anything else as far as location specific for these markets. On feeder cattle, a little bit of a difference. For feeder cattle, you tend to see a premium for feeder cattle out of South Dakota relative to other locations that are included in the CME feeder cattle index or reflected in feeder cattle futures prices. I think of it as well, I had to look up who was on the, kind of translates into about a $50 bill. President Grant was on the $50 bill the, for folks keeping track of that at home. So think about a typical feeder being worth $50 more than feeders from other locations. For calves or stockers, a little bit of a difference here as well. A little bit more tricky because it's not just reflecting location, but also some of the feed costs that would go into calves in a given location. So you could look at using a 5-year average here, but I've got a couple of differences shown here. I've got a line going through that would be the 5-year average, but I've also just highlighted 2024 or what was basis levels last year, cash price, 5 to 6 weight steer versus the nearby feeder cattle futures price. I would lean towards using 2024 in part because the earlier years in the average reflect very high corn prices and very high hay prices and relatively lower live cattle or feeder cattle prices that these are benchmarked against. So because the prices in 25 are very similar on the input side and the fed cattle side and feeder cattle side to 2024, I would use those basis levels as a rough guide for what you'd expect if you were looking at evaluating a forward contract bid or doing some hedging or other risk management, trying to benchmark calves against the feeder cattle market. That's what's going to be used if you're using the futures or options market, and also LRP. LRP uses a little 10% adjustment for for calves, and that really doesn't quite align with the basis level that you'd see here in terms of the percent. So just something else to think about or be aware of in a difference on calves and stockers versus feeders. A couple other price series to show, just for perspective. Here's the overlaying all of the June live cattle futures prices from the last, and it's winter, so excuse me for just a second. Ah, runny nose. Get back on track. This is overlaying all the June live cattle futures contracts from the last 12 years. I did that so we could grab the prices for 2014, 2015. So the top blue line going across the top is this year's June live cattle futures price. Um, Seasonality shows up in cash prices. Seasonality disappears when you look at specific um, futures contract months. So looking just at the June live cattle, all that seasonality that you'd see in cash prices doesn't show up when you look at specific futures months. So here's June, and currently June is sitting at it touched 200 a couple of weeks ago, and it's sitting at a higher level than all of 23, 24, or the contract that expired in June of 24. And you can see that there's really no rhyme or reason or consistent pattern in terms of moves or changes looking back historically. Some years it moves up, some years it moves down. Just to throw that out there. And the prices for this time of year have never been this good for June cattle or cattle for June delivery or June settlement. So good price level from a seller standpoint. In terms of volatility for the cattle, live cattle and feeder cattle, the C-vol, the nearby volatility, had been spiking or had spiked quite a bit recently. So I pulled out just the June live cattle implied volatility, plotting that over the last year just to see what's happened or what's going on. You see you've got a couple of times where the volatility has increased sharply and then fallen back down. So the last big cycle here was in the last few weeks. Volatility late November was down around 11%. Recently, it got up to 15% before coming back down here to about 13%. So that whipsawing of volatility has meant option coverage or LRP coverage would have gotten more expensive and corresponds with price run up or the futures price rising too. But it's not causality, it's correlation between those two aspects. With feeder cattle, same type of thing. Feeder cattle here in the last few weeks, if we overlay the August futures contracts, so reading this chart, it's all the historic August futures contracts through their expiration the last Thursday of August. So very recently, this year's 25 contract had been higher than all the other prior years, but recently we've slipped back down right below last year's August futures level. So here too, there's no seasonality to read into this. It's point in time estimates of what prices will be like at the end of August. Volatility in the feeder cattle market, a little bit tricky. It has been fairly flat across the nearby default stuff you'd pull up. So the volatility just looks kind of the same everywhere. Backing out, we've got Bloomberg, so we back this out to see what happens if we go further in or out of the money, which is where you'd be very likely making risk management decisions, buying an out of the money option, for example. So there you can pick up a little bit more of a pattern in the volatility. You can see it's a little higher the further out of the money you go. So if you wanted to purchase an out of the money put option, you're looking at higher volatility there. But overall, the volatility in the cattle market is very subdued or at the low end of what we've seen. In the interest of time, any questions? You can take any clarifying questions now or stick around until after Dr. Sellars talks as well. Going once, going twice. I'm going to stop sharing.
Okay, I think we'll turn it over to Sarah. So, Sarah, you can come on and share your screen.
Morning, everybody. Thank you so much. Really glad to be here today and be talking about the spring fertilizer economic outlook. So today I'm going to set the stage by starting with some discussion of farm income and prices that we're seeing right now. I'm going to give you the latest data on fertilizer prices, our three main inputs for corn, which are the NPK. And then I'm going to talk about the potential effect of the tariffs on those fertilizer prices and what you can expect for the upcoming year. I'll try to avoid the policy. I'll put in a plug for next month, the March Ag Economic Dialogue. We're going to be talking more of that, and I've been following that very closely. But we'll touch on some of it a little bit today with the farm income and the tariffs. So looking at farm income, so these are cash receipts. This is published by the USDA Economic Research Service. This was released on February 6th, and these are their forecasts for 2025. So this is the total income from selling crops, which is the blue line, livestock and livestock products, which is the orange line, and then all commodities, which is the gray line. So you can see the total income is projected to be down for 2025. A lot of that's being driven by historically low commodity prices that we've been seeing. But if you look at the USDA forecast for net farm income for 2025, it's actually projected to be up. So maybe you're wondering, how could the projected net farm income forecast be up when total income is projected to be down? So the difference is being made up by direct government payments. So the USDA is forecasting those at $42.4 billion for 2025, which is up $33.1 billion from 2024. So that's where we're seeing kind of this gap being closed, is with direct government payments. And what are those government payments and when can we expect them? So the main mechanism that they're using to provide this direct ad hoc payments is called the American Relief Act of 2025. This was passed at the end of 2025 and kind of had two components. One, which was a disaster relief component. So that was more of the money, $20.78 billion was allocated as disaster aid. And then $10 billion is economic assistance payments to help farmers through these times of lower commodity prices and higher input prices. So when can farmers expect to start seeing those payments? So the legislation was passed on December 20th, 2024. And as part of that legislation, they are mandated to get those payments out within 90 days of enactment. So that would be 90 days from that would be by March 20th, 2025. And at the bottom, I put a table of what farmers can expect on average for their estimated payment in dollars per acre. So for corn, they can expect $42.51 per acre. Soybeans is projected at $29.50 per acre, and wheat is expected to be $30.69 per acre. As with some of the other programs, we've seen some caps put on the amount of money you can receive. So the payment limit is you can receive up to $125,000 if less than 75% of your adjusted gross income comes from agriculture. If more than 75% of your adjusted gross income comes from agriculture, you can receive up to $250,000. And as I mentioned, this is to help with the decline in commodity prices we've seen. So we saw some higher commodity prices going into 2022 and 2023. And then throughout 2024 and 2025, we've seen a decline in commodity prices, which has caused some shrinking of margins for farmers and some softening of farm financial positions. And again, I just wanted to include wheat. We've seen the same with wheat as well. These commodity prices come down quite a bit. And those commodity prices are projected to remain low for the upcoming year. So this is the World Agricultural Supply and Demand estimates. They release price projections, and these are the most recent price projections they've released for February 2024, 2025. So they're projecting corn at $4.35, soybeans at $10.10, and wheat at $5.55. And all the kind of long-term projections that I've looked at have also projected prices to remain lower looking into the long term, unless, of course, there is some sort of supply or demand shock to the global commodity market. When it comes to production expenses, we've seen some production expenses come down a little bit, and we've seen some increase. So above the black line, these are all the expenses that the USDA is tracking that have increased projected to increase in 2025. So the light blue bar is 2023, the dark blue bar is 2024 forecasted, and the yellow bar is 2025 forecasted. So you can see some projected increase in labor costs, some livestock poultry purchase increase, slight seed increase, some property tax and fee increase, and net rent increase. But we've seen some other expenses come down in 2025, such as feed purchases. Interest has come down slightly from 2024, it's showing, but it's still up from 2023. We haven't seen much movement on that yet. Fertilizers come down a little bit, as we'll see, but some of the tariffs have potential to disrupt the fertilizer market a bit, and we'll talk about that. And fuel and oil costs have come down a little bit too, but no huge changes and decreases in any of these costs, really. So I just want to talk a little bit about what we see in South Dakota specifically. So these are our South Dakota crop budgets that we release every year. These kind of show a snapshot or average of give you an idea of yields and prices and costs for a South Dakota farmer in different regions. They're just an estimate, so we have a spreadsheet tool where farmers can put in their own numbers and update all of this themselves with their own data to make it more accurate. So again, it's hard to get to represent all farmers' financial position with the budget. It's just kind of an idea of where people could be at, but it gives us an idea about what the financial budget looks like for a South Dakota farmer for 2025. So this is for the East and Central high production region. For the yield, I use a trend crop yield. So over the last 50 years in South Dakota, on average, corn has increased 2 bushels per acre per year. Soybean, spring wheat, and winter wheat increase about 1 bushel per acre per year. So I took last year's yields and I just adjusted them by that trend yield increase. I chose an estimated selling price. I consulted a lot of different price projections, and I tried to pick something middle of the road, not too optimistic, not too pessimistic. But again, that can change depending on the market conditions. And then if you get the price times yield, you get your revenue. There is a line for other crop income per acre. I don't factor in any crop insurance payments, government payments, potential ARC PLC payments. We leave all of that out of these budget estimates. So government payments are not factored into these calculations. But if a farmer wants, they can add their own estimates in that box there. Then we come up with some seed, fertilizer, pesticide, and other cost estimates. These are based on the application rates for different commodities of fertilizers on the SDSU Extension fertilizer guidelines. I pulled all of those from the SDSU Extension website. So I come up with some general estimates of what I think a typical farmer in that region would be applying. And then I come up with some cost estimates for how much those products cost, and multiplying those together, we get the total fertilizer, seed, pesticide cost. And again, these are just estimates, so farmers can go in and enter all of these on their own to be more realistic to maybe what they're experiencing on their farm. So then after subtracting out a machinery cost and a management charge, we get the total return to land. So for corn, that's estimated to be $275 per acre. soybeans, $145 per acre, spring wheat, negative $32 per acre, and winter wheat is $24 per acre. So if you're cash renting your land, your return to land, you're going to have to be able to cover your cash rent with that. So with some of the cash rents we've been seeing in these regions, SDSU Extension puts out a great report looking at cash rent and land values in the state. So if we think about subtracting that number out of there, it would tighten these margins even more or push them even more negative in the case where they're already negative. And this is the same budgets, but for East and Central mid production. So the change here is we're seeing lower yields in this region and then different application rates of fertilizer. So overall, the return to land is lower on some of these lower productivity land, which is what we would expect. And now both spring wheat and winter wheat are negative projected in these budgets. And again, if we're cash renting the land, we would need to subtract out that land cost or be able to cover our cash rent with this. And as we keep moving into lower productivity land, so this is the Central and West low production region, we see those financial budgets declining even more. So now 3 of the 4 commodities we're looking at are showing negative numbers on the return to land. And corn is slightly positive at $8 per acre for our return to land. Again, that's just an estimate. It's not based on actual farmer financial data, but it just gives us a feel for what the financial conditions are like right now. Now I want to jump in and talk about what we've been seeing with the fertilizer prices. First, let's start with the ammonia price. I pulled all this data from Bloomberg, and I tried to show a picture over the last 5 years so we can really get a feel for what happened. Because you'll see in 2022, we see really high fertilizer prices in P and K, all of our main fertilizers that go into corn production. But we also saw high commodity prices then too. So we were in a bit different of a financial time. It was not as challenging back then. And now the fertilizer prices have come down some, but they're still high compared to, for example, 2020 levels, what we were seeing for ammonia. So now we've seen this sharp decline in commodity prices, and we've seen fertilizer prices come down, but not quite to the levels they were before. And now we're seeing these tighter margins that we didn't see in 2022. So for our weekly ammonia price, the most recent data was released on February 14th, and that was at $455 per ton. This is the price at the New Orleans terminal. So this is at the Gulf. So this does not include any transportation costs. So of course, they'll ship it up the river or get it up here to South Dakota, and you'll have to factor in that transportation cost. But overall, we've seen a slight decrease in ammonia price since the fall. And that's due to a more stable supply. And also one of the main factors in ammonia price is the natural gas price, since that's the main component in ammonia production is natural gas. So it's highly related to natural gas price from the supply side, but also commodity prices from the demand side. So it's also part of that's being driven by the demand side, and the softening commodity prices drives down demand for nitrogen fertilizers. So we've seen that come down a little bit since fall. And so ammonia and hydrous ammonia, 82%. That's what I showed on the previous chart. This chart's probably a little overwhelming, but basically what I wanted to show is that if we think about our other products like urea or UAN, they're just going to be always be a little bit more expensive than anhydrous ammonia, because we start with anhydrous ammonia, 82% nitrogen, and then we further refine that to get urea and UAN. So there's always additional cost from that. This is our DAP price, which is phosphorus. This is at the New Orleans terminal, so there's no transportation costs covered in this price. But that's up a little bit. It's $605 per ton as of February 14th, the weekly price. And this is a $50 per ton increase since the fall. So we've seen that coming up a little bit since fall. And again, it came down from the historic 2022 highs, but it's still not back to where it was around 2020 when fertilizer prices were lower. And this is where we've seen the most increase, which is our potash, our potassium fertilizer. This is the Northern Plains price, so it does include transportation. So we've seen that come up quite a bit from the fall, up to $350 per ton. So as we'll talk about with the tariffs, that's what's driving a lot of that uptick is the tariffs have the potential to affect the potash market the most because we import most of our potash from Canada. So again, it's come down from the highs we've seen in 2022 from some of the supply chain and global fertilizer market disruptions we saw at that time, but it's still high compared to what we saw 2020 and before. Now let's talk a little bit about what we can expect going forward with all this discussion of tariffs. How could this affect our fertilizer prices? So the tariffs don't really have probability to affect the nitrogen price very much. The U.S. produces most of its nitrogen itself. We only import about 6 to 13% of our total nitrogen that we use since 2020. We're the third largest producer of ammonia, which is the first form of nitrogen. So you can further refine that into UAN and urea, whatever other products you need from that. So we produce most of our ammonia domestically. We don't rely a lot on imports. The other big producers of ammonia are China, Russia, then US is third, and then India. So we keep most of that for domestic use. A lot of that's produced in the south, close to where the sources of natural gas are. So in figure 1 below, we have the total imports, which as I mentioned is a very small proportion of our total nitrogen use. The red bars are the total amount of nitrogen we import from Canada. The yellow bars are the nitrogen we import from China. Green is Mexico, so we don't really import any nitrogen from Mexico. And blue is the rest of the world, so any nitrogen we import from the rest of the world. And the tariffs, they're talking about placing tariffs on Canada, China, and Mexico, so those are why those are the main countries included in that chart. So we really don't import any nitrogen from China anymore either. So the only potential that the tariff has to affect is Canada. And again, we don't import a lot of nitrogen, so I wouldn't expect it to have a very large effect at all. Then, as I mentioned, natural gas is strongly related to the price of nitrogen. And in the past, we have imported quite a bit of natural gas from Canada, but we've been moving away from that as well toward more domestic production of natural gas. And actually, in recent years, the U.S. has become a net exporter of natural gas as well. So because of the strong natural gas production and basically no reliance of the U.S. on imports for nitrogen use, the price should not be affected very much by tariffs. Phosphorus mostly comes from Peru and Morocco. Those are our two main sources. So this would not be impacted by the tariffs either. We don't import any from Canada, Mexico, or China. So I would expect the phosphorus price to be mainly unchanged as well if tariffs are implemented. So with our potash or potassium, that's the main place that the tariffs would affect, and they could increase the price of potassium by $100 or more per ton. So most of the potassium we use in the U.S. is imported from Canada. 80% of the potassium imports have been from Canada since 2020. So that's where we get most of our potassium. The other sources are Russia and Belarus. And so one question you might have is, well, could we just exchange that trade we've been receiving, the imports we've been receiving from Canada, and import them from somewhere else? There's been some complexities in trade relationships in recent years with some of the sanctions placed on Russia. And Russia's main trade partner for potash is China. So that's their number one trade partner for this commodity. But I guess it just depends on where trade relations go going forward. If we have higher tariffs and prices on that potash from Canada, if we could substitute some of that import from another place or not. It depends on how the trade relationship is going forward. So now I want to get into what to think about based on what we're seeing in fertilizer prices. We're seeing these tighter margins for farmers due to declining commodity prices and some higher costs compared to where we were in 2020 and before. So I wanted to discuss the idea of profit maximizing when it comes to inputs versus yield maximization. So historically, we've seen a lot of push toward yield maximization, towards trying to achieve the highest yields possible, because in a lot of farmers' mind, higher yields equal more profit. But economically, we know that's not really true, because eventually we reach a point of diminishing returns. So where we maybe continue applying an input such as nitrogen, and we see little or no yield response, that doesn't cover the cost of paying for that additional unit of nitrogen. So the graph on the right is supposed to show that, as you can see, there's a optimal nitrogen rate based on that idea of diminishing marginal returns. So kind of shifting that mindset from thinking about yield maximization to thinking about profit maximization and factoring in costs into that decision. So my recommendations would be to revisit rates and soil test results, review all input recommendations. SDSU Extension has great input recommendations based on trial data collected all across the state. They do a really good job of gathering all that data, putting it in nice documents and putting it out there for farmers to use. So I would go over that documentation and compare it to what you're doing now, see what the recommended rate is and where you're at, and think about this idea of profit maximization versus yield maximization. I know a lot of farmers already are, but we still have a few that are really focused on yield. Another thing to explore is site-specific recommendations. I'm going to talk a little bit about that and about a project that we have going on related to that. And then you can expect higher, if the tariffs are implemented, they got pushed back until March 4th. So if that happens March 4th, expect higher potash prices after that. The other inputs shouldn't be majorly affected. So we're working with this project to think about site-specific profit maximization. So farmers have a lot of farmers have precision technology that's gathering a lot of data about the characteristics of their field. But a lot of times we're not really using this data to run experiments or make decisions on the farm. So it can move past kind of using these broad region-based recommendations and think about running your own personal experiment in your field to try to optimize an input such as seed, fertilizer. So I'm involved we have 2 trials that I work with that are going on right now. One is to find the optimal soybean seeding rate in this field, which is what this picture is. And then we have another trial that's testing 2 inputs. It's to find the optimal UAN rate, and it's also testing Pivot Bio, so we can test different products to see if they work. So we're testing Pivot Bio to see if there's a yield effect from that using this, what's called data-intensive farm management. So this is a project. It's based out of the University of Illinois, but it's got collaborators all across the Midwest and world. So basically what we're doing is running small trials all across a farmer's individual field using their own precision data to try to find the optimal rate of whatever research question they're interested in answering on their farm. So for example, this farmer was interested in finding the optimal seeding rate on their field. We started with his status quo seeding rate, and then we designed a trial based on that. So the farmer picks kind of where they want the variation of starting in. So he wanted his seeding rate to vary from 90,000 to 140,000. So we use precision data to create that exact map across his field and test that question to see if we could find what's the optimal soybean seeding rate on this field. And also we can answer if variable rate seeding is more profitable than just applying a uniform rate across the field. Overall, we found that his most profitable soybean seeding rate was 90,852 seeds per acre. And you can see once he reaches a soybean seeding rate of 124,948, his profit really declines compared to some of these other rates. So we can find that kind of exact profit response to seeding rate for the overall field. And then we can think about breaking that down based on different characteristics of the field. So on the left, we have elevation level and profit. We can map out the elevation level of the field and look at how that affects the profit. On the right, we have soil type and profit. So we can think about factoring that into the rates and how the soil type affects the optimal soybean seeding rate. So we provide the farmers with all this data, all these reports, so they can use it to make management decisions. And it's best if we have multiple years of data, because this is just 1 year of data. So of course we have the weather effect. It's better when we have observations across multiple years to come up with an optimal seeding rate. This is just one way to kind of start thinking about optimizing at a really site-specific field level. So what we ended up finding for this farmer is that planting at the uniform optimal rate would have raised his profits by $32.70 per acre. And if he planted at the site-specific optimal rate, so this is variable rate seeding, it would have raised his profits by $33.91 per acre. So you can see there's not a very big financial difference between the uniform rate and the variable rate profit difference for seeding. And this is the group we have working on DIF, data intensive farm management, here at South Dakota State. So I'm working with a couple of farmers. We also have Jason Clark. He's assistant professor and SDSU Extension soil fertility specialist. So he's starting to get involved with data intensive farm management as well. He's going to do some nitrogen tests in the upcoming year to collect some data. And then this is the team we work with at the University of Illinois, who came up with the system, the trial system, and they run all the database and computer system that produces all of these reports. So that's one way farmers can think about kind of optimizing their input rates, and with these times of higher fertilizer prices, lower commodity prices, it's something that farmers can consider doing. And as part of that program, the program covers any losses of economic losses that the farmer incurs from doing these experiments, because we know there's risk to experimenting with this type of things, and we don't want farmers to have to bear all of that risk. So there's a no loss guarantee as part of the program, which is designed to cover farmers' losses from doing any of that experimentation. So my overall takeaway is net farm income is down, but as we saw from the USDA data, that government payments are actually showing to increase net farm income compared to 2024 levels. Most of that's being driven by that economic assistance payment, which would be expected by the end of March. We have seen fertilizer prices come down from the highs of 2022, but they're still not back to pre-2020 levels. And with the lower commodity prices, it's putting farmers in more of a squeeze and causing some erosion of some farmers' financial positions. If we think about the 25% tariffs, which are scheduled to take place potentially on March 4th, they shouldn't affect nitrogen and phosphorus prices much, but they have potential to affect potassium price by more than $100 per ton, because when a tariff is implemented, a lot of times a lot of that tariff gets passed on to the purchaser of that product. So the company will bear some, but then the farmer who's purchasing that product will see an increase in their price as well. So this is a good time to think about revisiting input decisions for the 2025 crop year, exploring the SDSU Extension website input recommendations, or even thinking about experimenting with some site-specific trials on your farm. And with that, I'll open it up happy to take any questions. And you can also email me, call me. I'll be around and happy to talk about this. I love following these topics and love to talk about these topics. So happy to take any questions.
So Sarah, as you were talking, I came up with a poll question. So I'm going to throw that up for everybody quick. So if you guys could answer this question related to your fertilizer that you've pre-purchased so far this year. Let us know if you're not a fertilizer user, or how much of your fertilizer you've already got pre-purchased, if you would, please. So there's about 17 of you that should be responding to this. So click the buttons. No judgment zone. I'm going to have to put my glasses back on so I can see the poll questions. All right, so we got a handful of you answering. So looks like some have some to be purchased yet. So, all right. So, any questions